Well, thank you very much, and we can call us a bit like a rock band in the '70s, that Matthew and the Peters or something like that. So, uh, and we also try to prepare for the technological difficulties. I've heard that there were some in the past in the previous panels, so therefore we have no slides. Um, let me just quickly introduce our distinguished panelists. The first one is, of course, the Matthew. So Matthew Karuna from Malta, from the GE Malta Foundation. After that, we have Péter Nagy, the CMO of the Budapest Stock Exchange, and Péter Táncos, a partner at Euroventures, and I am Péter Fájkis. I am director responsible for international business development at Hold Asset Management. So let us start our discussion with a short introduction. So if you could say a few words about yourself, what you're doing, what is your interest,
Sure.
that would be great.
So Matthew from Malta. JA stands for Junior Achievement. We're an educational institution working on entrepreneurship education and financial literacy, financial education. I've also set up a crowdfunding platform in Malta. I was also one of the directors of the European Crowdfunding Network. So yeah, my interest here today is more on the crowdfunding side and helping young entrepreneurs or new entrepreneurs to kick off.
Great. What is the situation at the Budapest Stock Exchange, Peter?
Hello, my name is Peter Gábor Nagy, Peter. I have spent my whole career on the capital markets here in Hungary, almost 25 years. At the start of my career, I was an equity analyst, then a stock exchange trading system expert, and then after that, for 13 years, an equity investor, institutional investor here in the region. I joined the stock exchange 6 years ago, and I'm the head of the issuer acquisition and sales division, and my team is responsible for finding and helping fast-growing Hungarian companies outside the stock exchange.
Great. Péter Táncos.
Hello, everyone. I'm Peter Táncos. I am the managing partner of Euroventures and currently the chairman of Hungarian Venture Capital Association. Euroventures has been investing institutional money into venture capital, into early and growth stage companies for the last 35 years. I myself for 33 years. Just reflecting on the comment before that we should use templates for startups to present their business plans. Imagine how boring it would be if I would read the same 10 pages for 33 years. So we tend not to issue templates in the future as well, just to be surprised by new ideas of new people.
But certainly, it's somehow there were some changes in the past 30 years in the templates, and it's changed a lot in Hungary and also in the whole CE region, the risk capital and also the whole VC spectrum. So, what is currently the biggest challenge in the VC realm? What you're facing in Hungary and maybe in a broader perspective in CE?
If I may start, I think startups or companies many times forget that we have also two sides of the business model. One is when we are seeking investees, but the other side is also seeking LPs, investors to our funds. And I think one of the biggest challenges these days for a venture capital fund manager is to raise new money and raise new money from the right sources into Central Eastern European companies. I think that's the single biggest challenge now, because we will discuss that later. If investors, global investors, look at the comparison between the risk presented by this region and the kind of average return of the sector, this is very disappointing.
And it's because of the high interest or high yields on the international markets, or why this difference is so tight currently?
I think, unfortunately, like for like as well. So if you look at venture capital as an asset class in the US or as an asset class in BRIC countries, Asia, and compare it to Central Eastern Europe, you see that the average return is lower and not really compensating the risks that are associated with this scattered region.
I see. What are the main challenges in the capital platform? So let us start with the crowdfunding, Matthew.
Um, I think one challenge that was there until, let's say, 2 years ago. 2 years ago, it got a bit better. Was obviously when we talk about Europe versus US, we think Europe as a collective, but obviously there's a lot of fragmentation from a regulation point of view, from language point of view, culture point of view. So there's that fragmentation that we need to overcome. Regulatory, the EU, the European Commission, they're trying to obviously create more and more single market concept. So there's a trend there that maybe is getting better. We mentioned the challenge of the capital limitedness in Europe. I think it was mentioned as well earlier on that the protection focus. Once I heard sort of a saying that China regulates for the state, US regulates for the business, while EU regulates for the consumer. So it's always consumer heavy, which stifles a bit the innovation there. And I think another thing we're lacking, especially from a crowdfunding point of view or a challenge, is closer to home as well, is the lack of education. So when it comes to financial education, financial literacy, both as startups, as innovators, as entrepreneurs, but also as investors, the retail investor, the public out there, we need to focus more on education. Also because currently the trend is that there's more information. The influencers, social media, there's a lot of information out there. So it's not an issue of education, information, but it's an issue of educating and understanding that what I'm reading, what I'm seeing is actually good or bad.
I see. And at the stock exchange, what kind of challenges do you face now?
Okay, let me start with a textbook sentence. The stock exchange is a barometer of the economy, and if you check the challenge of the European economy and the European stock exchanges, they are common. We must improve competitiveness in Europe in order to catch up with the US and China. And if you check the numbers on the stock markets, like market capitalization, turnover, liquidity, number of IPOs, Europe is far behind of China and US. And the problem with that this leads to lower company valuations, lower multiples. Just check the price to earnings ratios in Europe and US, and you will see a huge difference. On the other hand, there's a huge amount of household savings available in Europe. It's approximately 50% higher than in the US. But on the other hand, and this is the bad news, it invested in a very conservative way. Not only less than 20% directly in equities in Europe, and it's the same ratio is somewhere between 40 and 50% in the US. So what is the consequence? What is the solution? We need to convince the retail investors and educate them to take more risk and invest directly or indirectly in equities. They can use investment funds, ETFs, and some new innovation solutions as well. And this will also help the demand side of the market. The supply side of the market. If the company sees there are a lot of available funding on the market, they will choose crowdfunding, VCs, and stock exchanges as well. So I think this is the solution. Find the retail investors who unfortunately lack the knowledge, educate them, and additionally we can give them some financial incentives like tax reliefs.
We will talk about the opportunities and the regulation as well. So you can give some advice to the policymakers here in the room. You didn't mention, but some of the people are saying that the generational differences could be also a quite big challenge. So the alpha generation is coming, the Z gen is already working now. There could be also some differences between the Y and the Gen X. How do you see this challenge? Could you start, Matthew?
I think if I attach this answer to what I mentioned before as the challenges, I see the new perspective of the younger generation could possibly be actually an opportunity rather than a challenge. The younger generation are more tech driven, more self-service or DIY investing, whether the older generation are more still dependent on a broker, on advisor, while the younger generation have a bigger risk appetite as well. So when we need to mobilize the savings, the household savings, and that's why also one way of crowdfunding being useful in the whole ecosystem. We're talking about building ecosystem, so we need everyone. We need crowdfunding, we need VCs, we need business angels to really help the part of the startups grow as they go along and at different time cycles. So the younger generation, possibly when the savings move also from one generation to the next, there'll be more risk appetite, more the idea of the technology of tokenization, so sharing the risk and splitting also that adds accessibility and access across all strata of life, including, as we were mentioning before, sometimes with VCs and business angels, there are certain cohorts in society which are still underrepresented, let's say women or migrants and so on, while crowdfunding could give new avenue to that. There are certain cohorts in society which are still underrepresented, let's say women or migrants and so on, while crowdfunding could give new avenue to that. And the new generation also is somewhat value driven as well. So all the investments, the startups need to cater as well for that. So this is another challenge possibly, but also an opportunity for people to look into. So I think between the technology, the blockchain, the tokenization, the crowdfunding platforms, the regulation improvement, and the different mindset from the young generation could be an opportunity for more and more startups to help at the initial level where they're kicking off their life cycle and then moving to business angels and VCs or IPOs.
Do you see any significant methods how you could convince them much more easily to join to a crowdfunding platform or something like this? Or it's just communication, and it's just the behavior, how they are?
I think from a behavioral point of view, they already have that appetite. They can see that they can take a small risk compared to a business angel, so they can enter the market at a lower level. Other type of investment classes are crowding them out, so it also brings them in an opportunity. And I think it's also the communication, the marketing of it, and that's why crowdfunding portals also have this opportunity. When business angels and VCs most of the time happen behind closed doors, crowdfunding gives that opportunity to people to explore and get aware more, get excited about it. We are excited when we see a big US startup got sold for I don't know how many millions, but we need more of those stories going out there from Europe. So having these portals, having these marketplaces, let's call them, where there's money meeting ideas and innovation, creates more traction and innovation there. But again, I come to my usual disclaimer, we need proper education as well to really be able to allow them to invest strategically and maybe by diversifying their portfolio and so on, which again, the tokenization and crowdfunding could be a way of actually allowing this.
That's great. What do you think, Peter Táncos? I would turn to on generational differences, also as a workforce and also as a customer, how differently they are looking at investments.
Yeah, I'm not a specialist of kind of retail investors and generational differences, but maybe a unique perspective is from comparing how our entrepreneurs acted or the employees in the startup companies acted over years. And I see a very positive trend that we can measure actually as well. One example is that you have ESOPs in companies where venture capital is present, basically an employee participation program in the equity of the company. And We offer those into in every portfolio company over the last 30 years. But we always were cautious of checking if the value of that small option or equity participation is properly valued in the mind of the person who receives that. So therefore, each and every case, we offer the option to take a cash bonus versus an ESOP participation. And what we see is that the decision to take an ESOP participation is increasing significantly over the past, let's say, 6-7 years. Whereas before, it was a surprisingly high ratio where people said, okay, if I can take a bonus, I'm happy to take the bonus. And then you realize you would have given up something which has high value for someone who doesn't really value that as a real proportion. So I think this is something which is a positive situation. The other thing is we were lucky enough to have some very successful companies with founders who became high net worth individuals after the exit. And it was interesting to see how they behave as now investors themselves. And whereas 15 years ago, it was the usual story of someone, the next day going to a private bank and kind of creating a diversified portfolio based on the advice of the private banker. Now what we see is that relatively young entrepreneurs becoming millionaires, they're immediately going to the market as business angels, developing their pipeline and making sure that sometimes crazy allocation of their net worth goes into very high risk early stage investment opportunities. So I think there is a very distinct change in the behavior of these people, who I have to stress are not usual and not certainly average retail investors. They are usually risk-taking people, but even they change remarkably over time.
It's because of the the education of that how they understand the ecosystem, how they could give back to the ecosystem during these investments, or it's really you see a generational shift in a sense that it's yeah.
I think greed is something which helps. So in those cases where employees are opting for the ESOP instead of the cash bonus, I think it's education. So they learn about the success stories and they want to be part of it. They don't want to be missed out. And in terms of the entrepreneurs kind of allocating a higher proportion into high-risk asset classes, I think it's just the eagerness to make another story and become another part of another very good success story. It's just that kind of need for adrenaline.
I see. We talked about the challenges of VCs in the CE ecosystem. What do you think that what are the main, what is the value proposition of these VCs, or what could be the value proposition of VCs in the CE region?
I think that's a question that we and our competitors are thinking about every day, because it's not an obvious one. I think we had a very good slide there in the previous panel about what are the unique problems of Central Eastern Europe, being a region with many countries, with many different legislations, different languages, with limited IPO possibilities, and I could go on. I think there was a very good list there. So what can you do if you are acting in this market? I think the value proposition that we are looking for is matchmaking of deep tech knowledge, basically the unique innovative skills of many Hungarian and regional engineers who used to learn from people who were used to or were forced to work with limited resources, and therefore they were forced to be innovative. And that is something which is uniquely still puts Central Eastern Europe into the global map. On the other hand, what is not there is the ability to sell whatever they come up with in the global markets, and surprisingly enough, also the ambition to become really global and really a significant player in the international markets. And I think what we can do is help the matchmaking of these different talents meeting here, and kind of present a track record that you can do that, because we were lucky to have seen that many times with great people. So I think that's the value proposition, which is hard work to do.
Let's see, actually, you mentioned the greed and also the the high risk potential. What is the Budapest Stock Exchange is considering? What kind of specific measures have you taken actually to support this kind of listing these kind of high growth companies?
Okay, small, medium enterprises and high growth enterprises are the backbone of the European economy, and all of the European stock exchanges realize that we as a stock exchange should focus on these segment. We offer a wide range of services to SMEs, and since 2016, helping high growth companies is a core element of our strategy. In the last 10 years, we have built an ecosystem around the stock exchange. It contains more than 500 Hungarian companies, and about 100 local investors and advisors as well, who helps these companies become publicly listed or just to grow and develop. And we offer to this community, to the companies, networking events, educational programs, and the knowledge of financing options here in Hungary. In 2017, we have launched a new market segment, a junior segment. The name is BET Extend, and it is tailored for the high growth companies. The listing requirements, the conditions, the parameters are much easier than on the main market. Fees are lower. The company should not have any history, so it is also good for startups. 25 companies listed on this market today, and more will come, I hope so. And it is also a funding opportunity to these companies. We have seen in the last couple of years almost 40 funding transactions on that market, and it is also an opportunity sorry, on the long term for these companies to grow and enter the main market as well, but also an opportunity for founders and owners like VCs and private individuals to gradually decrease the ownership in the company or fully exit at the end of the story on the long term.
Go ahead, Matthew.
Have you seen in the junior market? Is it more on equity or is it bonds issues?
Equity, but we also have a so-called X-bond market for bonds.
You mentioned returns and also the high growth. What already Péter Táncos mentioned earlier, that the expected return and risk issue that could be a challenge. What do you think about it? That, you know, in the last year we have seen the S&P 500 increase 25%. Before it was also over 25%. So in this situation, what could be the right balance in that the expected return, the risk, and also the illiquidity? How do you see Péter Táncos and maybe Matthew, if you could comment on that?
I think that's a difficult challenge. If you, for example, present to a pension fund in Hungary or even in the region, it's not an obvious choice why they should, even if they allocate money into this asset class, why they should allocate that portion into funds that are investing in Central Eastern Europe. And As we know, there is a ratio which describes this relationship, the Sharpe ratio, which has a nominator, which is basically about the return of that asset class, and then the volatility in the divisor. You have to work on both. And I think this is a usual thing that people forget when we compare returns of different asset classes. When you talk about the asset class of venture capital, you should focus really on top quartile companies, and that being in the top quartile helps with the nominator of the Sharpe ratio, but also being a kind of serial venture capitalists, like serial entrepreneur, that also helps with the decreasing the volatility. So I think what might help in this competition is to provide outstanding returns, and that's sometimes, it's something which I tell to myself when I complain about the ecosystem, when I complain about the number of investors coming in and the lack of LPs ready to take the challenge of investing into Central and Eastern Europe. Frankly, you have to deliver good returns, and if you don't, you should not be of relevance. And I look at our kind of story as well, that in the past, decent double-digit returns worked well for our asset class. And I think looking forward, probably it's not going to be enough. You have to be more exciting to attract private investment.
How do you see, Matthew, at the crowdfunding world, this challenge?
I think to tackle it a bit differently, I would say there's sort of two elements to it you could look into. Is one, that when we're talking about diversifying a portfolio, it's not purely industry or type of or asset class, but it's also keeping in mind the timeline, the short term, long term things, investments you're doing for the long haul, and also for the shorter term. Obviously, when it comes to VCs investing in startups, we all know that's high risk, high reward. So you need to also keep in mind that there are certain in having a portfolio. Some startups will bring down the average down, but you're looking for that one that actually will make it big and offer you a return for all of them. So I think it's something to keep in mind as well. And in the space, what helps is liquidity or activity in secondary markets, because that gives more confidence that. So I think it's something to keep in mind as well. And in the space, what helps is liquidity or activity in secondary markets, because that gives more confidence that if I need to sell out because of personal circumstances or other opportunities are arising for me, there's a market I can get out from. So say the importance of secondary markets and the development of secondary markets for startups is also very, very critical.
I see. Let's talk a bit about the regulation. There was some very good news, I think, in the last year. We have ESOP legal framework in Hungary. We have also the convertible bond framework already, or note available for startups and also for funders. I think therefore it's a big compliment to the ecosystem, and of course for the ministry responsible for culture and innovation. However, do you see we also have a crowdfunding regulation across the whole European Union. So how do you see, do we need any urgent regulatory changes, or just maybe fine tuning is needed? Maybe we can go for maybe a whole round. I don't know. Matthew, would you start?
I think from a regulation point of view, we as you said, we're moving. It's much better than it was in the recent past. So I think from a regulation point of view, now it's also a way of understanding what's happening and fine tuning rather than maybe creating other things. Having said that, we're always a bit critical of the European ecosystem, that it's highly regulated and we go with regulation first as a stifles innovation, but it's also a reflection on the market. Sometimes in Europe, having a regulation on something makes it more mainstream. People gain confidence in it. So I think it's a very tight balance when we're talking about regulation, between giving confidence to investors but then not over protecting them, at the price of innovation. So that is one aspect that regulation needs to keep in mind. And also possibly regulation should be seen more of a holistic approach. So if on one hand we're trying to promote more green concept, ESG concepts, then we need to also encourage or give incentives or promote that also when it comes to investments, to share options, the crowdfunding regulation, the MiCA and everything is also directing towards the same things, so that there's one concerted effort in pushing everything together rather than isolated pockets. And then obviously the harmonization between the countries in Europe helps because it makes the market bigger, more comparable with things like US, for example.
I see. Peter Nagy, would you go? Any of you?
I
Any
will finish
Peters?
this round.
Okay.
First of all, I agree with you that last year was a year of many wins. The Hungarian Venture Capital and Private Equity Association has been working for a long time to achieve these results in terms of the convertible notes and also improving the possibility of an ESOP. There is still a lot to improve, even in these regulations, to kind of be more efficient, more practical for the purpose, and that requires trust. And developing trust between the different stakeholders requires time. So I think we have to be patient in that sense. If you look at kind of usual international ecosystems like London, like the Netherlands, Luxembourg, these, those ecosystems needed time, tens of years to develop the trust that things will change or not. So you can actually build on regulations that are there to stay. I think that's one thing. The other is how to make sure that when you are a player in this ecosystem, then you're incentivized to stay here for a longer time, so even the ecosystem can benefit. And there, I think there are still hindering factors. One of them is FDI regulation. The fact that if a Hungarian company would like to exit, it requires, in many cases, ministerial approval with submitting the exit documentation. That is quite a significant hurdle in many situations to do an exit, as quickly as possible, as flexibly as possible. So I think there is room to improve.
From the stock exchange point of view, it's a bit different. I just mentioned MiFID II, MAR, CSRD, DORA, and so on. So it's more than enough. And there are hundreds of pages behind these EU directives, and it's continuously growing. So what is the future? And it puts a significant burden on smaller markets and participants here in Central Europe. Sometimes it makes very hard to sell risk to investors on the public market. Regulation is good because it builds trust in the public market, but on the other hand, there's always a room for some relaxing steps. And the good news is here that the new EU Listing Act will simplifies the issuance and listing requirements of small and medium enterprises and high growth companies and startups on the public market. For example, there will be a limit of the length of the listing document, and this will be 70 pages. Which were more than 100, or there were even not a limit on that one. So hopefully this will help the public market on the long term.
It's good news that there are some improvements in that sense as well, and hopefully with small steps. For regulators, it could be also a big step from some perspective. But the good news is that there will be more high growth companies. Hopefully, there will be more companies could be listed, and actually we are only between us and we are between the audience and the launch currently. So hopefully we should a bit speed up at the closing. But before closing and before the room for the audience questions, I would be curious about the future. So how do you see the future, the change of maybe the business model of the VCs, Peter Panzers? What is your view on that? So currently there is a quite nice framework. We know how it works here also in the CE. What is your expectation? Or maybe, and we skip the phrase AI so far, so it's a big achievement, I think, currently. No one mentioned it, but now I have to mention it. So how do you see that challenge as well?
I still recall a conference back in 2001, I think, in London, where the whole title of the conference was The End of the Golden Era. And I remember I was there representing a similar sized fund in London, and I realized that the whole budget of the fund is that is sitting next to me for managing the fund management operation is bigger than my whole fund. So that there used to be times where it was very normal that a kind of normal market size fund had 2.5% management fee and worked from a 50 million euro budget, which was usually the size of our funds. Now that golden era has ended long ago, and I think there is still things to come that will change and kind of rewrite the business model that we are working in. This is also visible when we go through different rounds of fundraising ourselves. We see what the LPs are looking for and what they're pressing for. And those trends are basically the following. They want fund managers to put more of their own money into those funds. I think that's a very clear situation. Instead of putting up, let's say, 1 to 2%, they push for 10% of participation or even more from the fund managers, especially if those are repeat fund managers. The other thing is that a fund manager usually makes its living from management fee and, more importantly, from the carry, which is the upside of investments, which is shared disproportionately between the fund manager and the LPs. And there is a trend that you can negotiate a trade-off between decreasing the management fee and increasing your carry. And I think that makes the life of those fund managers easier, who are ready to make that trade-off, because LPs like that, and GPs who are ready to take a bigger risk, they should also benefit. So I think these are the likely changes, not from one day to the other, but certainly over time those things will change.
So the risk capital will be more risk
Yeah.
capital than it before. What is the situation? What is your expectation for the future? Let's say for 15 years from now, so 2040 or something.
So I think from my end, from more on the crowdfunding and the retail investor side, there's increased in democratization of asset and investment, so reaching more cohorts of the society, and therefore also having a greater impact on the fractional ownership concept. AI and blockchain will help the platforms be more efficient, also with robo-advisors and things like that, but also from an operational point of view. The blockchain gives more transparency, more trust to people out there who are also more knowledgeable about it, the younger generations, so that will also increase. There's an element of impact investing that's growing, maybe not as fast as one would hope so, but there's also an element of that growing within the new type of investors. So I think the landscape is getting better also because in some regulation, as we saw in the crowdfunding regulations, there's also the concept of suitability. So adjusting regulation for the different types of fundraising, for the sizes of fundraising, and for the investor type as well. So I think all in all, the picture is getting better also because the youth are more interested, the European youth are getting more interested in entrepreneurship. They're getting more the idea that finding employment first and then shifting to entrepreneurship later might actually switch to first try something new, be entrepreneurial, be innovative, and then eventually, if it doesn't work out, I'll switch to employment. So it's the other way around. which is a mentality we've seen in the US for a number of times. So I think linking to this, also I think we need to have a mentality shift and also a regulatory shift also when it comes to insolvency, bankruptcy, to help you to take that plunge even more.
So there are supply and startups, for instance, is good news actually. How do you see, Peter Knight, the future for the stock
I'm
exchange?
very much in line with Matthew, what you already mentioned. From a stock exchange point of view, 10 to 20 years from now, we should focus on two main trends. First is technology, and the second one is the changing investment behavior. You already mentioned the first one. At the Budapest Stock Exchange, we already have various working groups where we're examining the use of blockchain technology and AI. But you must know that we are very well regulated, and there are a lot of IT security concerns about blockchain and AI as well. But I think on a long term, in 10 years' time, this will be solved. And the second one is the changing investment behavior. I think the future is very bright. And let me share with you with a personal example. I have a 14-year-old son, very interested in investing and in technology and in sustainability. He has already a Lightyear account on his mobile, and he's just starting investing with a small amounts and trying to learn how to become very rich person.
You should also show them actually the crowdfunding platforms
Yeah,
as well, something like this.
And another word we haven't mentioned much today is actually also when it comes to 14-year-olds and is looking into crypto trading and crypto investing and speculation also in crypto. So I think between AI, the loads of information on social media and influencers that there are on it, it is something we need to really focus on the education side to make sure that 14-year-olds looking into this do not get experience a bad experience and then shut down completely and do not give it another try when they actually know more what they're doing.
And as a closing before the audience question, just very briefly, what would be your very short advice to those who want to raise funds in either sector, so in VC or want to raise funding in crowdfunding or want to raise money from the stock exchange? Who would be the bravest to start? Would you start, Peter?
Happy to. I'm about to raise funds probably next year. So my best advice to myself: deliver returns.
And for entrepreneurs who want to raise money from VCs?
I think they should focus on their customers and realize revenues, because those are the cheapest source of financing. And then, if they're successful with their customers, then the funding from investors will come.
Okay, Matthew, Peter.
I think I'll build up on that. Yes, sort of. Yes, you need to look on how to make your investment in you be attractive, your pitch. And that the market is there and wants what you're offering. And this, again, portals like Toke Portal, crowdfunding, actually hit both fronts because you're getting early market validation, you're raising funds, and you're building a community that are your clients, but also your investors. And that brings in, even in line with the previous panel, that what startups want is actually that. They need to make sure that their product, their service, their idea fits the market. So getting early customers, going to the market early as possible. So if you need to fail, you fail it early. So go to market and raise funds and convert your clients into investors and build that community that's loyal, that become brand ambassadors for you to take it elsewhere.
And Peter?
For a company,
The bigger players.
For a company, if you have a long-term commitment to performance and transparency, and you can clearly communicate your strategy and your company's values, you can target the public markets and an IPO. And in a nutshell, be brave and dream big.
Be greedy, as we discussed. Maybe we have some time for one question from the audience. If anyone wants to raise a question, then turn to the, or everybody is just waiting for the lunch. Probably yes. So I would hand over. Yeah, we have one. We have a brave one. So go ahead. Could you be a bit louder? Okay, who would take it? If I understand it correctly, that what could be the situation with the asset tokenization with natural assets or flats or companies or crowdfunding shares or anything like this. Okay, so would you take that, Matthew?
What I mentioned before, that the concept of tokenization and that fractional ownership and sharing the risk is getting more and more popular, because obviously if we're trying to tackle more diverting savings and getting more people into the space of investment, we need to open it up to more channels, more individuals, and by lowering the entry points, I think that's one thing that tokenization is doing. It's lowering the entry point for me, that with my little amount of money I can invest in various things, even with smaller amounts, because traditionally a few years ago, with a small amount of money, you wouldn't be able to diversify. You had to put them all in one type. So I think the situation is getting better with the MiCA regulation, with crowdfunding regulation. I think the concept of fractional ownership is growing, and that is also an answer to getting all those savings that was mentioned before and growing the pool of investors. Because if the trend of VCs is going down, we really need to mobilize the general public to invest in ideas, in innovation, rather than other assets, I don't know, like property, or going to the US to invest there.
Well, thank you very much. Thank you very much for being in the panel and for all of these fascinating answers. Thank you for the audience for the patience, because now is lunch. So please give our not yet. Oh my gosh. Oh my god. Oh my god. Sorry for that. Anyways, please give a big applause to our distinguished panelists, and I will give the mic back to the stage.
Thank you again for the one and only Matthew and the Peters. I'm sorry to disappoint, but we will have one more block before lunch. So don't leave, it will be very interesting.